an entire system based on real market logic. And that is what I'm going to show you in this video today. And I'm not just going to show you what to do, I'm actually going to prove to you why it works. Because in my experience and from what I have seen, it's only once you have that true understanding that you will be able to execute flawlessly that is required for long-term consistent profitability. Most people don't make money consistently. And just because some of us just got these results, I cannot guarantee that you will get the results like our highest performing students, but what I can guarantee is that these are the results of others who are using this systematic strategy based on real market logic. Like Dom here, who was about to give up and he was going around in circles for 5 years, and then once learning and implemented the systematic strategy, he had multiple 5-figure payouts, he qualified for the FTMO scaling plan, and he reached the FTMO worldwide leaderboard. Hugo before was crying, frustrated, losing money, and then after 8 months, he secured $500, multiple figures in payouts. He had a 73% returns. And we also have Ariel, who had tried multiple other strategies, just going nowhere, getting no results. But then after implementing this, he secured $200K in funding and had almost $9,000 in payouts from just 2 weeks of trading. And for everything that I'm going to show you guys today, I want you to know that I'm speaking from experience. I started my career as an analyst on a commodities futures trading desk almost about a year ago now, and I've vast experience trading many, but it was only the true underlying market implemented systematic strategy based on those that I experienced consistent success and witnessed firsthand the impact that has had on the thousands of students we have now had the pleasure of working with. And that entire system based on real market is what I'm going to show you today. I'm going to give you everything that you need and nothing that you don't. Now, this is not going to be just some high-level montage, just to spike your dopamine with perfect little trade examples, tricking you into thinking you actually achieve something, because you're never then going to be able to actually apply it in reality. So today, I'm going to make sure that you can close this gap between where you are and your true potential so that you can start making real progress. Now, trading is bloody hard, but it can be simple, and there are things that make up successful trading. You need to have a profitable strategy, you need to have strict money management, and you need to have the mindset to execute your rules consistently. And today, those 3 parts. So we're going to go deep today and we're going to cover a lot. First, we're going to lay the foundations of what actually is FX trading, how much money can you make, accessing capital, market mechanics, so how the market really moves. We're going to look at market microstructure, auction market theory, order flow. Then we're going to hop on the charts and do the juicy technical analysis, looking at market structure, institutional supply and demand, liquidity concepts. Then we're going to put it all together into one cohesive strategy with entries and trade management. Then we're going to dive deep into money management, how you actually trade an edge. This is where we look at the essential but pretty basic trading math that you need, trade plan, backtesting, brokers, trade tools, and trading psychology. And I'm going to break down every step to scaling from 0 to consistently profitable from experience, not theory. And most importantly, I'm going to put all of this information into an actionable plan so you can start your trading journey today and consistent progress. Now, as you can probably tell by the length of this video, we are going to cover a lot today. I can only go into so much detail. So I put together a free training here. It's an intensive 10-part video course. There is so much source in here that's completely free, no strings attached, okay? You can see everything that we cover within here. And you can even see that one of our members had originally gone through this and they passed their funding challenge just from this alone before then deciding to join us, okay? So if you look in the description of the video, there'll be a link in there for you to get this, okay? So let's kick things off with the basics. What actually is Forex trading? Now, to know that, we need to know what the actual Forex market is. And it is a global marketplace in which a nation's currency is traded for that of another at a mutually agreed rate. Okay, so we have people like us, retail traders and investors, got banks, hedge funds, institutions, as well as commercials, companies who need to exchange one currency for another, and that makes up the market. Now, if you've seen one of these before, like you've gone on holiday or seen this in an airport, this is where you can exchange your currency for another. So if you've ever flown, say, from Italy to Europe, you're going to change your US dollars into euros. So with Forex trading, currencies are always traded in pairs. So you buy one currency while selling another, and you aim it to profit from that difference in the exchange rate, right? So buy low and sell high. Pretty simple, right? Now, while there are obviously a ton of currencies all over the world, we recommend that you focus on the major 8 currencies here. Now, currency symbols always have 3 letters, and generally the first 2 letters represent the country's name. So here we can see New Zealand, and then the last letter is the name of the currency. So in this case, dollar. Now, a lot of the other currencies are called exotic, such as, say, the South African rand, but typically we don't look to trade these because they are not as liquid and have higher trading costs. Now, individual currencies, they do not have an absolute value, which is why we always price them against another currency. So we are always trading them as currency pairs. Now, in this case, we have the Australian dollar versus the US dollar, and we would just call this pair Aussie dollar, right? Now, if you wanted to buy this in Trader Talk, that's called getting long, okay? So if you were to buy the pair Aussie dollar, what you are actually doing is you are selling your Australian dollars and buying Australian dollars with them, okay? So you buy Australian dollars and you're selling US dollars. Now, it's a bit confusing. In reality, it's really simple. On your brokerage platform, which I'll show you later, you literally just hit buy or sell, and the broker takes care of that simultaneous buying and selling for you, okay? Now, the opposite would be if you wanted to sell that in Trader Talk, we call it getting short, okay? And what you'd be doing is you'd be selling your Australian dollars to buy US dollars. So you would do that if you think the Australian dollar is gonna weaken compared to the US dollar, right? A bit of other Trader Talk here is bullish and bearish, okay? So if you're bullish, generally you think something's going up, and if you're bearish, you think it's going down. Bit of a silly way I was taught to try and remember that when you're first learning it is bulls attack upwards with their horns, whatever you call them, and bears swipe down with their paws. It's a bit ridiculous, but it can help you potentially to remember that at the start. But like I said here, this is what your brokerage platform will look like with just simple buy and sell buttons, and they take care of it for you. So when you take those 8 major world currencies, you can make 28 currency pairs of those, but we recommend focusing on all of the ones with the US dollar in them. They are the 8 major pairs, as those are the most highly traded and liquid pairs. Now, when you look at a Forex quote, you will see, for instance, pound versus dollar, it will give you the number 1.3035, for instance, and essentially you have the base currency, which is the pound, and US dollar is the quote currency, okay? And essentially what that means is for every pound is worth $1.3035. Now, again, if we get long, pound dollar, what we're trying to do is buy low and sell that high and profit the difference. And if we were to short that pair, it would be the exact opposite. So where can we actually go and trade FX? Well, there are 2 main markets that people use for speculating currencies. We have the spot market and the futures market. The spot market is what I trade in and what we're going to be going through today. And this is what's called over the counter, okay? It's decentralized. There isn't actually one major exchange where all of this goes through. It's a decentralized electronics communications network of brokers, dealers, and banks. If you compare that to, say, the futures market, which is a bit more simple to understand in terms of this, where you have one central exchange, so for instance, the Chicago Mercantile Exchange, CME, all of the trading goes through that, a bit like the stock exchange, okay? And that is what is centralized. Now, this is quite important to know a bit later when we go through some stuff, so we'll revisit it then. Now, the Forex spot market is open 24 hours, 5 days a week. And the only market to eclipse this at the moment is the crypto market, which is open 24/7. So yeah, you guys who trade that are absolutely nuts. So the trading day in the FX market starts over in the East, over in Australia, then opens in Tokyo, then we get the London Open, and then all the way to the day in New York. Now, the bulk of the volume in most of the FX pairs goes through the European session and the American session, okay? So the trading day starts over in the East, where it first opens up in Australia, then Tokyo, and then as we move up into the Europe and then the American sessions, that's where typically the bulk of the volume tends to occur on most of the pairs, and you see the biggest moves. But we'll touch a bit more on this later. And here you can see that the FX market is the most liquid market in the world, with a staggering trade volume of nearly $8 trillion a day. So the 3 main benefits of trading the FX market is it's highly liquid, which allows us to have cheap transaction costs, minimal slippage, and there is a lot of capacity to scale your trading here. It's a 24-hour market, so there's opportunity around the clock to take advantage of it. And there's high leverage in the spot FX market, which gives you increasing access to capital. Now, we're going to dive into these in a lot more depth if you're not entirely sure what they are just yet, So don't worry, I've got you covered. Now, the two major questions on every beginner's mind when you're getting into trading is how much money can you make and how do I make that money trading FX? So let's dive into that. The profit potential in trading is made up of two factors: your individual skill set and the size of your trading account balance. Okay? So you should spend 100% of your time focusing on improving your individual skill set, and the capital will then find you and you will enjoy increased trading returns as a result. And the output of this equation is practically unlimited. Let me explain. Trading returns are measured as a percentage of your account size, okay? So you make a return in the amount of dollars or pounds or whatever you are trading, you as a percentage of the size of your account balance. So here you can see if you made a $500 profit and you had a $10,000 account, that would represent a 5% return, okay? And as you can see here, as you have increasing account sizes, the same return equates to a bigger difference in profit, okay? So for two traders, if they both make 5%, the difference between making a $500 profit or a $50,000 profit, the only difference is simply your account size, okay? So this is why at the start, you just need to put all of your effort into focusing on the skill set, right? Not how much money you're making straight away, but the skill set. Because then once you get access to those larger accounts, you're gonna produce those larger profits with that skill set that you... Now, trading is the most scalable business model on earth, okay? So let's look at this example. Let's say you start off with a $100,000 account and you make 6% profit every single month. Now, in the first month, that is going to equate to a $6,000 profit. Now, in the second month, you made the exact same return in percentage, a 6% return, but you have now brought home more cash, $6,360, because you are compounding, right? That 6% on a bigger account balance is going to relate to that bigger dollar return. And as you get towards the end, by the end of the year, again, 6% return, the exact same skill, you have now brought in $11,000, 390 in that last month, simply from letting your account balance grow. Okay, so return the same percentage every month and you will make more money every month. Now, I have no idea if Albert Einstein actually said this, but the most powerful force in the universe is compound interest. 6% per month is a magic number. Now, 6 times 12 might only be 72%, but when you compound that each month for a year, that leads to a 100% return. I mean, can you imagine any other investment where you can double your money every year, right? If you see there, you started off with 100 grand, 6% every month, and you have $200,000. So you've literally flipped your account by the end of the year. Now, is this possible? Absolutely. But is it probable? No. It's not likely that you are going to make 6% every single month. It's not likely you're going to get consistent profits. It's not likely you're going to make that 100% compounded return. It's possible, but it's statistically extremely unlikely. But do you need to make those returns to change your life? Do you need those returns to make a huge amount of profit in the long run? No. Many beginner traders have this fantasy, right? They jump on a compound interest calculator and they think they're going to be a millionaire within a year or so. But the reality is very different, okay? Even seasoned professional experienced traders are going to spend experienced lengths of time where their trading account isn't going anywhere. It's in drawdown, they're experiencing losses whilst they have different market conditions that is not conducive to their strategy, or perhaps they're just not performing as optimally. But you need to develop this long-term mindset and zoom out. You need to remove that 9-to-5 employee mindset, okay? Don't think in the short term. You're not going to be earning a consistent monthly salary. You need to be thinking more like a business, judging your results by the end of the quarter. Really thinking more about the results at the end of the year, not week to week or month to month. Now look, I am not here to impose limiting beliefs on anyone. But if your beliefs about trading are balanced, realistic, and empowering from the start, you will naturally have the greatest probability of success. Why? Because you will make the wrong decisions if your expectations are not aligned with reality. And the reason why I'm drilling this into you from the get-go is because I've seen so many traders who literally have a profitable strategy in their hands. They have everything they need, they understand it, but they go through this inevitable slow period of drawdown when market conditions aren't quite there or whatever, and they give up. They jump ship, they look for the new strategy because they are not grounded in reality. They think that they have to be profitable every month. They think they need to be profitable every trade. They think that they have to be making 10, 20, 30% every month. And it's ridiculous. And they end up going nowhere and being completely disillusioned. When actually, if they just had those balanced, realistic, and empowering beliefs from the get-go, even though they don't need to make 100%, if it's possible, they don't need to, right? To actually make a very, very profitable career from this. That's my job here today, to try and help you neutralize those fantasies and be completely, within the realities of what training is going to take. Because the potential is here, okay? Once you develop that skill set and you have that large capital, you can start bringing home significant returns. All of you are capable of making 20% in a year, okay? If you got $1 million, that leads to $200,000 in P&L. Cool, but what if I don't have that large capital yet? That's completely fair. And this is where prop firms come in, and they will provide you with capital and a share of any profits that you make as long as you stick within their strict risk limits. So generally how this process works is you will go through a challenge, okay, where you will need to say hit a 10% target and obviously do it within those risk limits. If you do that, there will usually be a second phase, which is the verification, which will have slightly easier targets to make sure you didn't just kind of fluke that first attempt. If you pass that, they will then award you with simulated funding, where you will then split any profits that you make. Now, FTMO is one of the leading firms as of the date of recording. You can have up to starting capital of $400,000. Now, let's say you make a 20% return. That is going to equate to a $80,000 gross profit. If you do your 80% profit split, that is going to lead to you taking $64,000 net profit home, okay? Now, the median US salary is around $59,000. In the UK, it's a lot less, around $45,000. So you can see straight away the opportunity that is available here from just one firm alone, okay? They also have scaling plans where if within a 4-month period, you have a 10% return, they will increase your account size by 100K, increase your profit split to 90%, and all the way up to having 2 million in funding. And again, that's just one firm. And this opportunity is real. Here is one of our members. They got their first ever profit split and they ended up making a 28% return, okay? It's an outsized return, but these are possible. And if you do these on these funded accounts, that's going to equate to a juicy profit split. Likewise, we had another guy here, had the first ever payout after joining us, nearly $10,000. And also Cornell, who joined us, and within 2 months, he also banked his first ever profit split. So again, if your beliefs about trading are balanced, realistic, and empowering, you will naturally have the greatest probability of success. The opportunity is there, but make sure you're approaching this with the right mindset. And this is what we help our members do, okay? A lot of people put this funding, this opportunity up on a pedestal, and they think it's just gonna completely change their life. And whilst that's true, you need to go in with your eyes wide open, okay? There are plenty of drawbacks to everything in life. And here's just some of the drawbacks that prop firms have, okay? I'm not gonna go through all of them, but just be aware. They are a great opportunity and they are a tool. They are not the be all and end all. Okay, and this is why I recommend, no matter how much capital you have, is that you actually start with a personal account. Here is where you can build your long-term track record, okay? Put in there what you can afford to lose, of course. Then, once you're proving profitability, use prop firms to extract capital from them and put them into your personal account to build that. If you've got a salary from a job, business, side hustle, any disposable income from that, add that to your personal account. Now, as you build that track record over the coming years, and if you're truly serious about this, you don't have to do this, but if you want to, you can look to open your own fund and manage capital directly. Just be aware that this is a big step, okay? There's a lot involved with that, legal, big cost, right? But you can have a long-term goal. Obviously, this is beyond the scope of a beginner training video, but something to potentially aim towards. I want to wrap up this section all about how much money you can make of just focusing on your developing your own skill set. You must become the asset. Once you have proven that you are worthy to handle capital, so we'll find you one way or another. So cool, we've looked at how much money you can make. We're excited, but our expectations are balanced, realistic, and empowering, right? Now let's look at how you can actually make that money. So as we saw earlier, the whole aim of the game is to buy low and sell high, or sell high and buy low. Pretty simple, right? But how do we know when a currency pair is over or undervalued? Well, there's loads of ways you can kind of categorize strategies, but probably at the highest level is either whether it's a technical strategy or a fundamental strategy or a hybrid of both. Now, with fundamental analysis, this is what kind of most people outside of trading think everyone is doing, which is essentially looking at the real world, right? You're looking at data, interest rates, employment rates, GDP, sales, industrial production numbers, inflation. There's a lot involved with this, okay? And the main reason as to why I don't look at this is because there are two types of strategies that you can also put them into buckets. One is what's called discretionary trading, and one is mechanical trading. Now, discretionary trading is decision-based trading, okay? So when you're doing analysis, whatever process you have, you're going to go through looking at all of this information to then come to a decision of whether or not you're going to execute that trade, right? With a discretionary strategy, you're kind of just doing it based on your own judgment, own market conditions. You're kind of looking at random things each time, and then you're making a gut decision on what you think is right or wrong, and then making that decision. The exact opposite of that is a mechanical, rules-based system, right? Where it literally tells you what to do in every scenario. So something happens, does it meet the criteria? No, don't do anything. If it does, move on to the next criteria, right? And then it will tell you whether or not to execute, okay? So if something is 100% mechanical, you can literally code it into an algorithm and the computer could execute it for you. Now, with fundamental analysis, okay, if we go back here, this is very, very, very discretionary. It's very hard to make this systematic and make it mechanical. And in my experience, mechanical strategies have a much higher probability of finding long-term success. Because what did we look at earlier? Trading simplified. 3 things. You need a profitable strategy, you need to have strict money management, and you need to be able to execute those rules consistently, right? So here's how I simplify trading, another way to think about it. Find a repeatable pattern in the market that you can exploit that makes money over time. Okay, that's what positive expectancy means. We're going to cover this in a lot more depth in the trading and edge module later. Okay, so find a repeatable pattern that makes money over time, that has clear rules so you can execute it consistently, that you can then tweak and refine over time, right? To optimize that profit, to improve it in line with changing market conditions. This is it. This is your job, and this is what we're going to go through today. The path to success is finding that systematic strategy, proving that it has a profitable edge with hardcore data. Okay, so you prove it to yourself. That way you will then have that bulletproof mindset to execute it consistently, right? Because when you go through that inevitable losing streak, you trust the data, you know your edge, and you execute consistently, you will then have consistent results. And then it will be sustainable because you trust in what you're doing in the long run. Therefore, you can start to scale those accounts, rocket, make loads of money, we get it, okay? That's the path to success. Consistent actions and anything will lead to your consistent results, okay? In trading, outside of trading. So when we look at those types of strategies, technical or fundamental or a mix of both, I prefer to just focus purely on technical. So what is a technical strategy? What on earth do I mean by that? Well, technical analysis is where we literally look at a price chart and we're spotting those repeatable patterns in price data that's already occurred, and that will give us an indication to help us predict what might happen in the future, okay? So here's a more simple way to think about it. We look at the price data that's occurred, we will spot these repeatable patterns, these footprints in the market that keep happening, and they will allow us to predict with a degree of probability of what may occur in the future to give us that profitable edge over time. Now, technical analysis gets a bad reputation, and rightly so. We saw earlier, if you look online, you can see all these ridiculous chart patterns everywhere. But geometric shapes do not explain why price moves. You must understand the market dynamics of how those prices are actually formed if you want to have long-term success with this. Before we dive deep into these market dynamics, looking at auction market theory, order flow, and the market microstructure, first we need to get a quick basic understanding of how a price chart is put together. So we're going to hop in TradingView and look at the symbols, the price types, the time frames, and candles. So the software that we use for charting is TradingView. Highly recommend using it. It's the best charting software in the world by far. So download a free account. Now, the first thing you actually want to do is search for symbols. So if you literally just type on the chart, and what you can do over here is filter those symbols by the market. Obviously we are looking at Forex, so we can do that. And these are going to be all the different symbols. So you can search for any pair. For instance, if you wanted to look for pound dollar, and then what it will show you, if I type it correctly, is the different data feeds, okay? Remember, the Forex spot market is decentralized, right? So there's going to be different data feeds from different providers, from the different brokers. So this is essentially what you'll get here. They're all generally the same. You'll see very, very, very minor differences, okay? So for instance, let's say we get pound dollar and we use the data feed. Now this will just be a simple price line chart. And what we are going to actually look at is what's called candlestick charts, okay? And I'm going to explain these in depth in a minute. The other thing I want to draw your attention to, okay, is time frames, right? So what you can do over here is pick the interval you are looking at. So at the moment, we are looking at a 4-hour chart. So what that means is each one of these candles represents 4 hours worth of price, okay? So this one is currently printing. It started at 10 a.m. That will obviously close at 2 p.m. Once 2 p.m. reaches, a new 4-hour candle will print, okay? And you can go through the daily chart, for instance. Each one of these candles represents a day. Cool, so let's dive a little bit deeper into what these candles actually mean. So each candlestick is made up of 4 things. We have the open, the high, the low, and the close. So when you get a bullish candle, okay, price will open up at the start of the candle and it will close for that time period higher than it opened, okay? So obviously prices have gone up, that's gonna be bullish. When it closes higher than it opens, then the wicks will be the low of the session and the high of the session, okay? And the opposite is for a bearish candle where it's gonna close lower than where it started that time period, okay? So for instance, if you were to look at how this bullish candle formed, right, for that entire time period, whether it's 1 minute, 1 hour, 1 day, it's gonna be made up of price action within there, okay? So when the price starts at that level, that is where the candlestick opens, okay? Price might trade down, okay? After that time period is opened, that will be the low of the session. This will be the high of the session, obviously the highest point, and then wherever it closes, that is going to be the body of the candle, right, between the open and the close. Here, that's the body of the candle there. Then you get the upper and lower wicks. They literally just represent the high and low of the session, right? The highest point and the lowest point of that time period that it traded. And then that is the entire range of that time period with that candle. And then you get the exact opposite for the bearish candle, okay, which I won't go through. Now, as you're starting to get this basic understanding of candlesticks and you see price moving there to the downside, does that bearish move, right? Can we say with 100% certainty, only looking at this chart, that it moved to the downside because there were more sellers than buyers? As you can probably guess, it's a little bit of a trick question, but we cannot say that that is the case because price can fall when there are more buyers than sellers. And this is why you need to understand the true underlying market dynamics of what is going on rather than just looking at these basic candlesticks without that understanding. See, the great thing about candlesticks is it obviously condenses a lot of that price information into a neat and manageable graphic display, which is great and it's useful, but it's the ultimate simplification of the market, right? Yes, we just see that candlestick, but we don't see what actually led to the formation of the candlestick. What was all of the interaction of the buyers and sellers and all of the dynamics of that market activity that led to that candlestick on a chart, right? You need to have that understanding. Okay, cool, but what is it that's actually going on beneath the surface that then leads to this price action? Well, as history has repeatedly shown, traders are often a very emotionally charged group. When millions of them get together in a highly emotional money game of fear, greed, and uncertainty, their combined behavior takes on a herd mentality. And we can actually spot this on our price charts and make money off it. How? Well, you've got millions of market participants putting millions of orders through the market for a million different reasons. All of this behavior and participation is what drives the order flow that is put through the market. And that order flow is what prints price action on our charts, and that price action creates patterns. And those patterns consistently repeat themselves if you know what you're looking for. Because those large players in the market, they cannot hide their activity, and if you know how to spot their footprints, then you can follow that money flow. So we know that price compresses all of those complex interactions between buyers and sellers into one single variable, but we need to understand what is the underlying behavior of each of those candles on our charts. So before we learn how to analyze price action, first we must understand the market dynamics of how those prices are formed. Then we can simplify with the correct understanding. Because remember, we want to keep trading simple. We want to identify a repeatable pattern that has a positive expectancy over time with simple mechanical rules that we can follow and then tweak and repeat. So before we simplify it on our price chart, we're going to dive deep underwater and we're going to look at auction market theory, market microstructure, and order flow. This is the stuff that you are not learning as a beginner trader, but it's crucial to your development. So currency exchange rates are a result of supply and demand in the market. Okay, buyers bring with them demand, driving upward pressure on prices, and sellers bring supply, driving downward pressure on prices. Now, a very simple thing that you need to get your head around is that no trades can take place unless both a buyer and a seller agree on price. So economics 101, if you've ever taken a class, where the supply and demand curves meet, that is where the current price will be, okay? And if you get any adjustments in the supply or demand in the market, those prices are gonna shift, okay? Where the market then agrees on a new fair price. And that process, right, of supply and demand adjusting the price is going on in the market every single second that it is open. And it's the market's job to facilitate that auction, to allow prices to fluctuate, to meet those buyers and sellers where supply and demand is in equilibrium. Now, don't worry if you don't understand all of that. We're going to simplify this on the charts. So when you actually look at a price chart, obviously on the right-hand side, you will see the price. But what a lot of beginner traders don't realize is that this is not a price you can trade, okay? This is what is called the mid price. So what I'm going to do is I'm going to add the bid and ask lines, okay? And we'll add the labels, make it nice and clear, okay? And these are the prices that you can add. So if you see over here on the right-hand side, if I was to do this price, which is higher, right? You buy at the higher price, the ask price, and you will sell at the bid down here. So, okay, so the prices that you see on the candle is the halfway point between those, okay? Let me explain. So as we just saw, what you see on most is the mid price, right? And then when you go to buy and sell, they are different there. So the bid price at which you sell to the market, okay? So if you wanted to sell, you have to sell to the highest bidder, right? The person who's buying. Okay, so if you wanted to sell, you would have to go down and you'd have to sell at a lower price, a worse price, right, than what you saw on your price chart. Because you're looking at the mid price, which is 106, 112.4. Okay, but you have to cross that spread to the downside. If you want to buy, you have to buy up, right? You have to buy at the ask price because that's where people are willing to sell, asking for this, or they're offering to sell it at that level, and you have to buy up there. Okay, so the difference between the ask price is the spread, okay? And that's basically the cost you pay to enter the market. And we'll cover that in a lot more detail later, okay? So there are essentially three prices at all times. The mid price, halfway between price, which is what you have to buy at, and the bid price, which is what you have to sell at. So essentially markets are two ways. And if you were to look below the surface, behind all of those price charts on there, you will see what's called the order book, okay? So on both buy and sell side, you have lots of on both the bids and the offers. So on the left-hand side, this is all of the demand at all of those price levels. So if I go back, see the blue box in the middle and that price, that is where the last trade occurred, okay? On the left-hand side, you've got all of the demand sitting on those price levels below the current mid price. And on the right-hand side, you have all of the supply sitting there, okay, on those higher prices. Now think of it like an auction or like eBay, where people are both bidding and offering to sell at different prices, right? And as I said earlier, no place unless both a buyer and a seller, they have to agree on a price. So to execute an order, it must be paired with an order of equal size, otherwise a trade can't take place. So for instance, at that price level, 1.1535, there is 67 lots sitting there, okay? So if 10 lots was to, there must be someone willing to buy at that price. Otherwise, nothing will happen, right? You can put your order there to sell 10 lots at that price, but unless someone comes and buys it from you, nothing is going to happen. So there are two types of orders, passive and aggressive. Passive orders are those that we just looked at, okay? So this is where you want to buy or sell at a price level that is better than the current price, okay? So if you want to sell at a better level than price, right? You're going to be selling higher than where price currently is. And if you want to buy at a better price, you want to be buying lower than where price currently is, right? Because you want to buy as cheap as possible and you want to sell high as possible. So if you want to do that, you put in a limit order, and these are pending orders. So a typical way you'd usually use these is if you want price to come down and tag you in, right? You want to buy at that lower level, or you want to sell at that high level above price. So when you're looking at an order book and you see all of those orders sitting there at those price levels, they are passive orders, okay? They're simply waiting to be hit. They're waiting for price to come down to the buy orders or waiting for price to go up to those sell orders, okay? Now, if we only had those passive orders, right, just sitting there in the order book, then the market wouldn't move because all of those orders are waiting to be hit, right? They're waiting for price to come to them. So how does price actually start to move to them? Well, this is where aggressive orders come into play. So aggressive orders are essentially market orders, and that is where you will buy immediately at the best current ask price or sell immediately at the best current bid price. Right, so remember, if you've got the mid price here and you just want to buy, you just want to enter in the market, you have to go up to that nearest ask price, right? You have to buy higher. Okay, so you immediately buy the person who had their resting limit order, you buy up from them, and if you want to sell, you sell down to the bid, the nearest bid, okay? You sell into that nearest buyer. So those are aggressive market orders. So if you're an aggressive trader, right, we just looked at all of these passive orders that are sitting on the bids and the offers, right? They're waiting to be hit. But if you're an aggressive trader and you want to buy at market, you are going to buy at that nearest ask price, right? You're going to lift the offer, buy at the ask. If you want to sell, you're willing to sell at a worse price and you sell down into that nearest bid, right? It matches the buy and the seller there. And that's how price is going to start moving through the order. Now, there is a third type of common order called a stop order for you who are a bit more experienced. And that is actually where you would have buy orders higher than the current market price. Now, as you can see there, there's nothing there in the order book showing higher people buying at higher prices, right? So you might be wondering like what's going on there. And that's because when you place a stop order, a buy stop order above the current price, your broker doesn't actually put that into the market in the order book. They hold on to it. And it's only once price actually reaches there that suddenly your broker will throw it into the market as a market order. Okay, and that's why you can get slippage on those. That's a bit more of an advanced thing, just if you are experienced and you're wondering that. But don't worry about that, we'll get into all of this in a minute. For now, just realize that pending orders are those limit orders sitting there waiting to be hit. They are passive, and the aggressive orders are the ones who are willing to cross that spread and they buy at the ask, they buy higher, or they come down and they sell at the bid, okay? Now, in reality, when you're looking at your broker and you want to just get involved in the market with a market order, you will just see the buy and sell buttons here, okay? So that buy button is showing you the best ask price, and that sell button is showing you the best bid price that you can sell into. Now, that interplay between those passive and aggressive orders is called order flow. So passive orders, like I said, are those limit orders just resting in the order book, waiting to be hit. Active orders are the market orders executed at the bid and offer. Okay, so passive orders are making liquidity. They are called liquidity makers because you are adding liquidity to the order book, whereas active orders are grabbing that liquidity, right? They're removing it from the order book, right? Once they hit it, they're eating it up. That's kind of a way to think about it. So passive orders are going to slow down and absorb price movements. Okay, so if you think about like all of the passive bid orders just sitting there, if active sellers are selling into it, those bids are just going to absorb that selling pressure, right? So it slows down if there's a lot of passive bids there. And likewise, if there's a lot of passive asks, as aggressive buyers are trying to buy into it, if there's loads of passive pending orders there, right? They're just going to absorb that price movement and, you know, make it slow down or even reverse, okay? So the aggressive orders are the ones that actually initiate those price movements and start getting price, you know, moving up that ladder. So down the depth of market, that is the same as what we just looked at on the order book, but it's an easier way to visualize the amount of volume of supply and demand at each price level. Okay, so you can see there in the middle, there's not a lot of volume at each of those price levels, so it's quite a small column. And then as we get further out, where there's a lot more volume waiting to be hit, you can see those larger or wider columns there, right? So liquidity is the ease with which a market can be traded without affecting its price. So you can see that on the left hand side where I've put shallow market, right? There's not a lot of volume. That is what we call lower liquidity. You know, if there's a lot of selling pressure coming into there, the price is going to move pretty quickly. Okay, so there's not a lot of depth there. Whereas where there is a lot of depth, it's going to take a lot more volume in order to get price to move. So this is why the definition of liquidity there is the ease with which a market can be traded without price essentially moving. Okay, so let's look at a simplified trade example of why all of this matters and how we can start to think about how we're going to try and take advantage of this. So let's say that this was the order book, the depth of market, okay? And a big trader is coming in and they want to buy 5,000 lots at market, okay? So it's just an aggressive order. It's just going to buy at the best possible ask price that there is, okay? It's going to take that liquidity sitting there on the ask. So now you can see that candle, what's going to look like. When that 5,000 order goes in and they buy, price is going to rapidly shoot up, okay? Because it's going to literally eat up all of that supply that was sitting there, all of those passive orders, right? If I go back, you can see there's 5,000 lots, but there's only 115 lots in the first one, 524, etc., etc. So it's going to rapidly shoot up until all 5,000 of those lots are filled at the best possible price it can get. But it's just going to keep going up until all 5,000 lots are filled, and then bang, right? It causes what's called a large demand imbalance, right? That imbalance between supply and demand is what causes those rapid movements. And price has to keep going higher and higher to do what? To search for that opposing liquidity, right? Demand is stepping in and it needs to try and find as much supply as possible to fill that entire order, okay? And now the market is sitting at that new price of 1.1540, and that is what the new current market price has deemed to be fair value. And we have this big bullish candle forming on our price chart, right? But this is what's going on in the order book beneath those candlestick charts, if you kind of think about it that way. Now, that big trader put 5,000 lots in, right? They tried to buy at 1535, right? That's where we started down here. By the time they get filled, all of those lots, their average price is probably quite a bit higher compared to really where they wanted to buy. So they've got filled at a worse price, which isn't ideal. And that's what we call slippage, right? They want to be in at 1535, but on average, they're probably in at 1538. It's not ideal for them. Institutions cannot hide those large imbalances that they are causing in the market, okay? And this is going to start to give us an edge in the market of how we can follow this and see their activity, right? So if you know how to spot their footprints on the charts, you can start to trade with their order flow rather than against it. Now, if we're not looking at the order book, right, what does that look like on a candlestick chart? Well, here we can see that kind of price is quite choppy. It's kind of just sideways. It's not really moving too much, right? The market is what's called balanced. It's where buyers and sellers deem it to be at fair value. They're all quite happy. At some point, there's going to be that overwhelming imbalance between supply and demand, where aggressive traders are going to lift those offers and there's going to be that imbalance. And then what's happening is there's an overwhelming amount of demand compared to supply. So price is going to shoot up until what? Until it can find that supply, that opposing liquidity, right? Where you've got those pending sell limits or aggressive sellers step in to absorb that demand. And then the market will rebalance. And then the market has now deemed that to be a new fair value. Price is constantly seeking that liquidity to rebalance price. And auction market theory explains all of this and explains that the market's purpose is to facilitate that trade in a two-sided auction, right? Between the bids and the offers. And the market participants are constantly seeking value, right? Whether you're a buyer, you want the best possible low price. And if you're a seller, you ideally want to be selling at the highest price possible. And the market is, acting as an auction to facilitate that process to help pair those buyers with those sellers. So what you'll see is that the market's kind of moving sideways and it will be a balanced market where the market deems it as fair value. This is what we call efficient price action. Now, at some point, like we just looked at, demand is going to massively exceed supply or supply is going to exceed demand. And there is an imbalance, okay? And this is where the market is inefficient and it will have to start rapidly moving to do what? To seek that balance, to find that opposing liquidity. And this is when we're in price discovery phase and you see those rapid movements. Until what? Until it finds that opposing liquidity and we're at a balanced market, okay? And that's the cycle that repeats. So how does that look like on a chart where you'll see a range in market, okay? As it gets into the top of that range, there's kind of the more premium prices. That's where sellers start to step in. They'll push price lower. Then the buyers will start to step in at the discount. They want to buy lower and price will range, okay? It's just a standard, relatively chilled market. Think of it that way. Now, if we zoom out a little bit, eventually aggressive buyers are going to lift all those offers. We're going to get that big imbalance where price is searching for where is that supply in the market? Where is that sell side liquidity to satisfy the current demand? Eventually it's going to do that. Okay, and we're going to get one of two things. Either we're going to get acceptance at those new high levels where the market participants agree on these new prices, or it's a failed auction, okay? And this is where price shoots up, but then we rapidly get an imbalance back down. Buyers cannot sustain those new higher prices, okay? They fail to agree on new prices, and this often happens at reversal points, right? And we're going to dive into this a lot more in a bit, okay? But let's just look at the first example where we do get that acceptance and we agree on those new prices. Eventually though, what we're going to get an overwhelming imbalance between supply and demand. It could be to the upside, it could be to the downside. In this case, it was to the downside. All of that demand was absorbed and aggressive sellers push price down, okay? Now, what will often happen, but not always, price will then rebalance at a previous level of fair value. Now, start to think why that may happen, because we're going to go to that in a little minute. Eventually, aggressive buyers in this case, they cause another bullish imbalance, right? Market searches for sell-side liquidity, rebalance, yada, yada, yada. I think you're starting to get it. So we have balanced markets, then we have imbalanced markets, where price is constantly seeking liquidity to rebalance price. So we have an accumulation of orders, we get an initiation out of the range, those orders start to get distributed, right? As people start to offload their long positions, sellers start to step in, we get an initiation down, accumulation. That's the heartbeat and the cycle of the market, okay? Where we have the balanced market, we get the imbalance, looks for new liquidity, we're balanced again, right? You're starting to see how this is working. And when you look at a price chart, which I'm sure you guys already have, you will see that sustained bullish order flow where price will range, but we're in a bullish market. Buyers are in control, they initiate out, balances for a little bit, right? Then they initiate out again, but eventually they'll run out of steam, right? Enough supply will absorb that demand and then sellers will start to take control and initiate that bearish order flow. Okay, so here you can see price rapidly initiates out of the range to the downside, creating a supply zone. And it's likely that this was backed by institutional involvement. Price then pulls back to mitigate the supply zone, where we can look to get short to catch the continuation. Now you can see the sustained bearish order flow as supply is clearly in control, but markets obviously don't move in one direction forever. Eventually the market moves low enough to discount prices, where demand then comes into the market to overpower supply. Then we see the sustained bullish order flow, and institutions will defend the levels that they entered at to keep their running positions in profit. And this isn't just me just picking up some bullshit. There is academic papers backing this up, of looking at why is equity order flow so persistent in the markets. And there's three main reasons, okay? One of them is splitting. So this is where, when those big players are putting their orders into the market, they will divide those large orders into multiple small orders. The other is herding, okay? So this is literally other players seeing those moves and jumping in on those price levels at the same levels, right? So a kind of herd mentality, if they're buying there, other people are going to start buying there. And then covering, okay? So this is where they'll be closing a losing trade. So let me explain those in a little bit more depth. So splitting, easiest one to probably get your head around. Big player, they want to buy 10,000 lots at the best possible price. Okay, now let's say they just want to put half of that into the market straight away, just to guarantee that they actually get into the market. We kind of looked at that before. Put 5,000 lots in. We know that the price is then going to rapidly shoot up to the upside and push price higher, and they're going to get slipped, right? Now what they're going to do is those remaining 5,000 lots, they're going to put back down in those previous price levels and add liquidity to the order book there. Okay, so if I go back, you can see here, they buy 5,000 lots, price shoots up, but then they're going to add the remaining 5,000 lots of those orders back down where that price initially initiated out of, okay? So you can see here, right, you would have had that fair range. Those 5,000 lots would have gone in, and then you would see price aggressively initiate out of that range. Now, where have they put those remaining 5,000 lots? They've put them down in that previous level. So if you can start to find these zones and areas on your price charts, you can anticipate that potentially when price revisits there, those that split large order is still going to have some remaining unfilled orders left, right? There's going to be some passive buy limits there. Okay. Now the second reason, remember, was herding. Other traders are going to spot this, i.e. people like us, right? And they're going to identify that there's likely going to be unfilled buying pressure there. So we're also going to look to potentially get in there and surf on those coattails, right? In line with their order flow. So that's going to add even more buying pressure and more pending orders to that level. Okay, so price may eventually return to that level, filling those buy limit orders, absorbing that supply. Okay, and the other third reason, remember, was people covering those losses. So people who were selling at that previous range, if price then goes up against them, right, that now they're in the red, they're losing money. If they're still in their position and price comes back down to that level, they might just think, do you know what, I've got out break even now, I don't want to be in this trade anymore, and they're going to get out of their short position. Now, if you've sold and you want to get out of that position, what do you have to do? You have to buy back your position, right? You have to put a buy order in the market to get out of that. So what are you doing? You're adding more buying pressure in that level, right? So you've got people who split their order and they've got left unfilled buy orders in that level. You've got people who are then herding and jumping in on that action. They're adding their buy orders. And then you've got sellers who are covering their losing positions. They're now adding even more buying pressure in that level. And that's why often you will see at those previous levels of fair value, the market will agree on those new prices again. And you'll see price start to level out in that area as the market rebalances and demand absorbs that supply. Okay. Now in this instance, you could say aggressive buyers potentially cause that demand imbalance again, and then the same cycle is repeating. So in this academic paper that they looked at, they actually found that the persistence of order flow was overwhelmingly due to splitting, okay, rather than herding. So essentially, when you see those big price movements, it's generally because the big players stepped into the market, and they're still going to have unfilled orders at that level. So when price returns to it, even days, weeks, months at a time later, you will see that buying pressure still come in. So to summarize all of that theory, you generally have markets ranging when supply and demand is balanced at fair value. Eventually, aggressive traders are going to initiate those breakouts, causing those imbalances, okay? And then you're either going to get acceptance at that level, or you're going to get a failed auction and price is going to rapidly reverse to try and find that new fair value. So our job is to try and essentially ride those imbalances to trade from balanced to balanced areas and capitalize on those moves. Now, in reality, reading an order book in the live market is extremely hard, right? Trying to understand all of that interplay between those passive and aggressive orders. Why? Well, there is a lot of manipulation, okay? So spoofing is one of the main ones, and this is where players will place large passive orders, but they have no intent for those to actually be filled. So they'll just cancel them when price gets there. Now, why would they do that? Well, Imagine a player, right, essentially places a large buy order around that level 1.530, okay, because they want other people in the market to think that they're actually going to buy there. So what will happen is other people will see that demand come in on the order book and they'll buy slightly above it because they want to get in just before them in case that big order is going to be filled and they want to ride that big bullish move. So what will then happen is as those other people jump in front of that big order to get in, that's actually going to cause bullish pressure, right? A little bit of bullish pressure. And the real reason is because the big player actually wants the market to come up higher so they can sell at 1539. They want to sell at that higher price, okay? So they put fake demand in at the lower price to get other people to buy the market up. And then this is the actual price that they want to sell at. And that's where they really want to transact at. So if price had actually come down to where they had that fake order, they'll just cancel it. They'll just pull it, right? They have no intent in actually getting at that level. So you might see all of this demand and supply in the market, but it might not actually be real. It might not actually, have intent to execute. The other one is iceberg orders, right? And this is where you can split large orders into smaller hidden portions to conceal its full size from the market. So you might look at this market and go, well, actually there's not a lot of demand at 1534. There's only 52 lots. But every time you sell into that, another 52 lots will appear and another 52, another 52, another 52, okay? Because they've hidden it with an iceberg order, right? So a price level may have more depth than what is visible. So it's very, very hard to accurately read order books and to make profitable decisions trading them. And that's not just it. You've also got limit chase orders, you've got time-weighted average price orders, volume-weighted average price orders, you've got dark pools where big institutional players are trading off exchanges with each other. It's very hard to get an accurate overview of how much orders and volume there is in the market. So what do we do? The problem with the order book, like I said, is that those orders are they're advertisements, right? They're just advertising that they might want to trade there, they might not. You don't really know. So one solution is to look at volume of actual filled orders. So you're actually looking at past trading activity of how much trading volume actually transacted. And you can look at more advanced things called the footprint, market profiles, and volume profiles, okay? Which is definitely a valid way to help do this. But here's the thing. One, they're not necessary to do it when you know what you're looking at on a simple price action chart. But the main problem is in the spot Forex market, as you guys know, it is a decentralized market, okay? There is no one central exchange. So therefore, no one has the aggregate, super accurate amount of volume, okay? It's unreliable. You only have access to volume data, okay, from a specific broker or, one specific pool. You don't have the entire market. Now, what you could go and do is look at the volume and the order book in the futures market because that is centralized. However, it's less than about 5% of the daily volume in the spot Forex market. So again, it's not very accurate. But don't stress because we have the framework via technical analysis of just looking at price action to have a very good idea of what is going on in that order book from a simple and much more mechanical rule set. And we're going to utilize these specific frameworks to look back of where did the big money enter and therefore where would it likely enter again in the future so we can try and capitalize with that. Because we want to be following that money, right? We want to be following that institutional order flow. Because we can start to identify these areas on these charts, which I'll show you how to do it in a minute, right? Where we can see these orders came in, but we've got random zones here everywhere. And even, how do we know which ones are going to hold, which ones are going to fail? And even if they do hold, how big of a move are we expecting? How far are we going to trade that? What are we going to do, right? We need to systemize this. And that's where your systematic strategy has to come in. How are you going to enter the market? How are you going to exit the market? You need to know these things ahead of time. And how are you going to manage your exposure to the market? Because we do not want to be entirely discretionary traders, just kind of making it up, acting on pure gut instinct, because it's going to be extremely hard to be consistent with that. Instead, we want to try and be pretty damn mechanical and later on prove it and execute consistently. Now, all trading strategies will fit somewhere along this scale, either completely discretionary or 100% mechanical so that you can literally code it into an algorithm. Because as a human trader, you actually have an edge and you can recognize patterns better than algorithms. Okay, and you can see there will be certain times and certain conditions. Okay, now as we're about to go through all of this, some of it you may have seen before, some of it you may have not have. It can seem like kind of these weird concepts and arbitrary rules, but just bring all of it back in your mind that what we are trying to do is identify the footprints of large orders, right, when they went through the market and where they may be occurring in the future. And if you can grasp that, and that's why we spent all of that time understanding the true underlying market dynamics, it will make understanding this so much easier and holding on to it holding on to your belief of why the concepts work, because then when you go through the inevitable tricky periods into trading, you'll find it so much easier to have that bulletproof mindset to keep executing. Okay, cool. Let's go through it. So to give you kind of a very high level simplistic overview of what it is we're about to go, right? The three core things of the strategy. You have random price action, and the first thing we're going to overlay is market structure. Okay, and this is what's going to help us to give us our directional bias. Once we know the direction in which we want to trade, right, we're not just going to jump into the market straight away. We need to know the location of where we're going to take those trade ideas, and this is where supply and demand zones come in. Okay, and then lastly, we're going to look at liquidity concepts, which essentially kind of help us with timing and identifying those higher probable zones, which we're going to get into. Now, again, quick little plug. If you want to get this free training where I'm going to go into all of those concepts in way more depth with way more trade examples and take it really slowly, don't forget, link in the description if you want to get this. Highly recommend you sign up. But anyway, back to the charts. Let's dive into it. So let's kick things off with market structure. In my opinion, this is the most important thing. It's the first thing I always start with. For me, market structure is king. It's the skeleton of the strategy. And then we slap on all the bells and whistles after that once you get this right. Because market structure will determine your directional bias. And that is most of the battle. Once you have your directional bias, we use other things to then help with timing. Get this right and everything else will fall in place, right? You'll be skiing downhill from then on. So highs and lows, right? Pretty much the first thing you want to look at. At the bare minimum, a high is going to be where you have a 3-candle formation and that middle candle is the highest high. Now you can draw that as a high in the market, and the exact opposite for a low, right? You've got 3 candles, and if the middle candle is the lowest low out of those 3 candles, that is essentially a structural low in the market. So if you just look at a price chart, you're going to get all of these kind of highs and lows there. If you were to draw a line through those major points, okay, this then gives you your structure, okay? That is what we are now trying to map. Now, the reason why we do that is because at any one point in time, you want to be able to tell what condition is the market currently in. Is it bullish? So is it moving to the upside? Is it just ranging sideways, or is it bearish? Market structure allows us to identify those conditions. Alrighty, so let's kick things off with some basic theory. And then as always, we will show you some real examples on the market structure. It's essentially what we call price making a series of higher highs and higher lows, right? So we get a higher high, price pulls back, but it doesn't break the previous low. So then we get another movement and we get a higher high. So let's break that down in a little bit more detail, okay? So what you want to do is you want to find a swing point in the market, you get a high, and you'll draw a line across that. And what happens is price will pull back, and then once it breaks that high, right, to form a higher high, we now have what's called a BOS, which stands for a break of structure, okay? So once we get that break of structure, at that point we have now formed a higher high, right? So we have a bullish market, and we can look back and find the new higher low. Okay, so again, price moves up, it pulls back, it breaks the high to form a higher high. We now have a break of structure. Okay, so aggressive buyers are buying this higher, and what is the market doing? It's searching for that opposing liquidity. We know there's going to be sell limits somewhere within this market that price is going to go into, and eventually the market is going to balance out, where supply is going to rebalance with demand. But then what happens? Eventually, we're going to get a pullback. Okay. Now, very often, basically after every time we get a break of a high, you want to start thinking about that pullback occurring. Now, once that happens and you get that break, you want to mark out where the previous low was, and now you know the current trading range we are within. Okay, so this is the bullish range between the low and the high of the market. So we get the BOS, the break of structure, price moves up. As soon as we get that break of structure, we want to start thinking about that pullback is going to kick in. So supply starts to overwhelm demand, and we get those aggressive sellers pushing price down, and we get that pullback. But because we are in an uptrend, because we are in a bullish market, right? Although we are expecting that pullback, we know that this is the higher low, and we call this a strong low, and we don't expect it to break. Okay. The reason why this is a strong low is because it had enough demand within there to break structure to the upside. Okay. So, oops, let me just get rid of those lines to kind of tidy it up a bit, right? This is the current range we're within at this point when price is pulling back. This is a strong low because it did its job. It broke structure to the upside. So now this is a strong low. We're trading within this range. After we get that break of structure, we expect a pullback, and we can look to sell this, right? If we get opportunities, but we understand that we are in a bullish market. The price is moving to the upside. Therefore, we know that we're not expecting price to go past this low. And at some point, we're expecting that demand, right, to start coming into the market to push price up again. So when that happens and we get that new higher high, right, we get another break of structure, what do? We look back and we find the higher low, and this is our higher low here. Now, after a break of structure, what do we expect? We expect the pullback to start kicking in, but how far is that pullback going to be? We don't know, but we do expect that it won't go past this low. This is a strong low, right? The buyers that broke structure, they have a vested interest in protecting this low, right? There'll be unfilled orders down here, which we'll get to when we get into supply and demand, right? And then we expect price to go higher. So it's a series of higher highs and higher lows, and that is a bullish trend, right? So strong lows, targeting those weak highs, right? We pull back into the strong low, and then when we start getting those long positions we want to buy, where are we going to target? We're going to target the weak high. What do we expect after break of structure? We'd expect a pullback. Down to where? Down into the strong low. Then we expect price to target the weak high. Okay, can you start to see how that framework's starting to come together? Very simple, but very, very powerful when you understand it. And the exact opposite in a bearish market, series of lower lows and lower highs, right? This high breaks structure. After a break of structure, we expect a pullback. How far is that pullback going to go? We don't know, but we expect that it won't go higher than the current strong high, right? So once price pulls back up into there, eventually it's going to start moving down. Where is our target? Our target is to the weak low, right? Down to the bottom of the range, we get that break. So now we have a new range, right? After we get the break, we look back, here's our new strong high, here's our low. So after a break of structure, what do we expect? We expect a pullback. We don't know how high it will pull back, but we expect that it won't go higher than that high. And then we can target the weak low, so on and so forth. Now, obviously markets don't move in one direction forever. We are going to get trend changes. So how does that work? Well, you have a bullish market, you have a strong low that breaks the high. After a break of structure, we expect a pullback. We have a strong low that breaks the high. Right now, when price is putting back down here, at that point in the market, obviously we don't have X-ray vision. We have to work with probabilities. What does our tells us? This is a strong low because it broke the high. Therefore, we expect price to pull back, but at this point in time, we are not expecting this low to fail, right? We expect it to hold. But what ends up happening is it does fail, and that's okay because eventually the trend is going to change, right? So at this point here, where I put the dashed line, once we get that break of structure to the downside with a strong low fails, we now have a confirmed trend change. We have moved from a bullish market to a bearish market. Now, what happens? You always want to be identifying wherever price is, what is the current structural range we are within? So if price is here, what is the current structural range? Well, you look back and you find that highest high that broke that previous low. Okay, so that's the range, and this is the low. Okay, so now we're in a bearish market. After a break of structure, we can play the pullback. We expect the pullback, but how far is that pullback going to go? We don't know how far it will be, but we expect it to not go higher than the strong high, right? This is a strong high because it broke the low. So we play the pullback up to there. And then when price starts moving down, where do we target? We target the weak low. Why is it a weak low? It failed to break the previous high, okay? So that's why it's a protected high. Big players have a vested interest in protecting it to continue their short positions for that bearish overall move, okay? So like we said, we had the expectation of a higher high forming. It didn't happen. We got a lower low, okay? So that lower low confirms the bearish trend change. We get another lower high and a lower low. Another lower high and a lower low, okay? Now, at this point in the market, what do we expect? We'd expect this high to hold. It's a strong high, but it ends up failing, and we get a higher high. So the bearish expectation of a lower high failed. At this exact point, when we get a break higher, we're now in a bullish market. So now we have a new range. This is our strong low. We expect price to pull back, but we don't expect it to go lower than the strong low. And then we expect price to target the weak high, and we're in a bullish trend, okay? So do you see how if you follow the concepts of strong highs and strong lows, you expect them to hold until they don't. So expect this to hold, it fails, right? We expect this high to hold, but it fails. So then this becomes a strong one. We expect it to hold, and it holds, right? Literally, it's very, very simple, but this will give you such a powerful way to frame your trade ideas in the market and to think in terms of probabilities and to have that high probability direction of where price is going to go. Now, in reality, obviously, we're not just going to have these perfect, nice, easy price movements. Price action is going to be a little bit more choppy, a little bit more range bound. We're going to see highs and lows everywhere, okay? So what we want to focus on is what's called swing structure. Now, swing structure tries to focus on those kind of major bigger swing points in the market, the real big clear highs and lows. So let's talk through that. So let's say we have a simple, easy pullback. Price breaks up higher. We know that. After a break of structure, we look back and we find the swing low, okay? Now, when the swing trend is bullish, the swing low is the lowest point that broke the swing high. Okay, so this is the lowest point that broke that swing high. So this becomes our swing low at this moment. After a break of structure, what do we expect? We expect a swing pullback, okay? So price pulls back. Now, whilst it's between the swing high here and the swing low, okay, price can do whatever it wants, but this is not swing structure, okay? We ignore that until eventually price breaks this high and we get a break of structure, okay? We get a new higher high. Now, at this moment, when we get that higher high, where is the new swing low? Okay, is it this low? Is it this low? Is it this low? You know, is it that low? Well, that doesn't make sense. It's already traded through. We want to look back and find it. The rules that we use is it's the lowest point always broke swing high. So when you get the high here, the moment you get the boss, you want to find the lowest point. A little trick to do that is draw a box of your swing high to where it was broken and then drag it down. And then the lowest point in there is your new swing low, okay? So this becomes your new swing low, and this is your new range. So now when price is pulling back, right, you can frame trade it that we don't expect this low to break. We can trade it short, we can sell it down, and then we can start to look to buy with confidence that we expect this low to hold, and we can go, okay? Now this might seem quite simple as I'm saying this and explaining it, but the reason why it's so powerful and why so many beginners particularly get it wrong is they don't have this framework or these rules. And you know, what do they see? All they look at in the market, like if I get rid of these lines for a minute, or I'll leave it on for a second, is price will be up here, right? And they'll see this low break. They go, okay, that low's broken. We've got a lower low. We're in a bearish market now. Okay, we've got another low, definitely in a bearish market. Okay, price gets up into this strong high. They're going to sell. They're going to sell with way more risk than they should. Right? Short, they're thinking, yeah, this is a strong high. I want to target the weak low, and then bang, they get stopped out. And that keeps happening and happening and happening. They're like, why am I getting caught on the wrong side of the market when that should be a strong high? But they don't understand that this is the true swing structure, right? The bigger, more, let's say, significant points in the market. And that's why having this rule is really, really key. So you will understand now, you have the understanding that when price comes down, this is just a pullback. This is just internal structure. And as we come down into that strong low, you are expecting that this is going to be the bigger move for that next big leg higher, okay? So really, really key for that. Same thing in the bearish market, okay? Obviously, we want to find the highest point that broke the low. We get the pullback. We don't know how far it will be, but we know it. We're not expecting it to break that highest high, okay? So that's swing structure. We find when it's bearish, the highest point that broke that previous low. Again, draw it from where the low was to where it's broken and drag it up. Find the highest point. That's your swing high, okay? Completely mechanical to find that. So let's hop on the charts and show you this with some real examples. So what you want to do with swing structure is just focus on the obvious swings in price, right? Really, you know, it says it in the name, okay? So here we can see we have a clear swing pullback, okay? And then eventually price breaks that and forms a higher high. So at this exact moment, what you want to do is look back and go, where's the swing low? It's the lowest point that broke that high, right? You can use the box tool here from that high to that low swing low. So at that moment, when price is pulling back, we expect price to knock that low at the lowest point, and then eventually price breaks that swing high to form a higher high, right? So then you want to find the new swing low. This is low, but eventually price then breaks it, okay? So now the expectation is filled. We have a lower low. This be strong high because it broke structure. This to be the strong high that holds, right? So we can play the pullback. Price won't go higher than that, and then eventually price will target the weak low, right? Because it's a bearish market and we get that lower low to the downside, okay? So price comes up and then we're expecting price to target that. Then what do we get? At this point here, we have a new break of structure. So we want to find the new range. Where's the highest high that broke the previous low? It's this high here, okay? This becomes our strong high. And you see now how we can trade high probable trade ideas around this, that after break of structure, we expect a pullback, but we expect this high to hold and eventually to the downside, okay? And we can rinse and repeat this. And this has been going on since literally the time markets have begun. Okay, so now we've started to see how we can map out the swing ranges and we can find a strong swing high and the swing low. This is what is called fractal structure, okay? These are the types in price. You see where you can see price comes down, then it pulls back. So we have a little fractal high here that we call it, and then price breaks that, okay? So these smaller little highs and lows in the market, that's what we call fractal structure. And we look at that to help us time when those pullbacks, those swing pullbacks may be starting and ending, okay? So when we get a fractal structure trend change, it's a bit weird, but we call it a change of character, or a chock for short. So let me kind of just explain this, right? We get a swing break of structure here. After a swing boss, what do we expect? We expect a swing pullback. So what we can look for is a break of the fractal low to signal the start of that pullback. And then we can look to play the pullback down into this strong swing low. Now, how can we look for a first signal that this swing pullback might be finished? Well, we look for a bullish change of character, right? We look for the fractal structure to change trend. So at this point, we mark that high. That is our bullish chock. And now when that happens, that's a pretty good signal that this pullback is over, right? We get the bullish chock. And now where are we targeting? We're targeting the weak swing high for a higher high. We get that swing break of structure. We get a higher high. Now what do we expect after a swing break of structure? We expect a swing pullback. And this is where we get that change of character, that bearish change of character, right? We get the shift. Price ends up dropping around, eventually gets that higher high, right? Then we get a bearish trend change. Okay, we got the bearish trend change, but we get the bullish change of character to signal the start of the pullback, right? Price comes into the strong swing high. How can we signal the end of the swing pullback? Bearish chock. We get that bearish shift in the fractal structure. Price moves down. Where are we targeting? We're targeting the weak swing low. After we get a bearish swing boss, what we're expecting the swing pullback, right? We get that shift of structure here. Up into where? Up into the strong swing high. When can we time the end of that pullback? Once the fractal structure shifts bearish, when do we get that? We get that change of character there. We get that fractal lower low. Where are we targeting? Now we're targeting the swing low. Right, rinse and repeat. Swing boss, swing pullback, bearish change of character. There we get the shift, target the low, right? So on and so forth. And we keep going with that. Now, it is an aggressive way of mapping structure, so you will get some false signals, okay? It's not a 100% win rate thing, and we're gonna pair that with all of the other frameworks that you're gonna learn. But it's a real spot, that first initial change in order flow where you get that fractal higher high, right? You get that shift. So yeah, now the rules that we use for that are 100% mechanical of exactly how we identify that and where we draw on the highs and lows. It's beyond the scope of this video for us to do that. You know, we reserve that for our members where we teach it. It's actually something that I've got my developer to code 100%. But for now, just identify those kind of smaller highs and lows, and it can really help you to time those opportunities. So far you've learned two types of structure. First, we looked at swing structure, which is the most significant. We just looked at fractal structure there, right? Changes of character, where we could change in fractal trend. That is the most aggressive way of looking at market structure. Now we're gonna look at the third final type of structure, which is called internal structure, okay? So we are getting quite advanced already. This is definitely not typical beginner content, but you know, watch this as many times as you need. I'm gonna hold your hand, we'll go through it slowly, and it will all start to make sense of how this framework comes together, okay? So swing, internal, and fractal. Swing structure is where we look at swing in price, right? We get a swing high, we get a swing break of structure, and we get that swing lower low. We can now mark that out as our strong swing high, okay? We don't know where our swing low is yet until we actually get that significant pullback. Then we can mark out our weak swing low, okay? So fractal structure that I just showed you on the chart, it's those little movements in price, right? These little movements down here where you get a high that gets broken and you get that fractal higher high. And that's what we call a change of character, a chock, okay? And you'll see those, right? So this little movement here is a chock. This little movement here is a bearish chock, right? Where a low that broke a high gets broken, okay? So little shifts in trend. Now, like I said, those are the most aggressive. So sometimes you'll get a chock, there'll be a full signal and we'll push down lower, right? Sometimes we'll get a chock and there'll be a full signal. So you have to be aware of that. And this is where internal structure comes in. So we might first see that chock. What we then want to see is a significant pullback come in. And now we're starting to form internal structure. So what internal structure is essentially these larger, more significant swings in price, but they form within the swing range. Okay, so sometimes what you'll get is really big swing ranges because you're a big impulsive move like this. So then the swing range ends up being really big. And then you'll get big highs and lows within there. And that's what we call internal. Okay, so after a swing break of structure, what do we expect? Expect a swing pullback. Now the signal we can use is the internal structure. All right, when that starts to shift bullish, that signals the start of the swing pullback. So as we start to form higher highs and higher lows with the internal structure, we know we're forming the swing pullback. Now we can start to follow this and buy this bullish internal structure, right, from these strong lows, look to buy it, targeting the weak highs. But what do we expect? Swing structure is the most important. And this is a strong high. And what do we understand? We expect that price is not going to break that swing high. So as we come into swing high, what can we start to anticipate? We can start to anticipate that the internal structure is going to shift back. So at this point, this is a strong internal low. It broke the internal high. Okay, price comes down into that strong low, internal low, and you could be forgiven for thinking, well, I expect it to hold, but this is where we recognize swing structure is king. The internal structure has fulfilled its objective, which was to facilitate the swing pullback. That job is now likely complete because we've come into the strong swing high, right? So now we're ready to shift bearish. So at that point, this becomes our strong internal high. So when we play the internal pullback, we expect that internal high to hold, and then we can target the weak internal low all the way down into the week. It's a lot of information to take in, I get it, okay? But that's basically the relationship. We have a bearish swing range, we expect the internal structure to shift bullish to facilitate. We'll expect the internal structure to shift bearish, and then we can follow that is taken out. So where does fractal structure come in? Well, fractal structure is that first little aggressive sign that we're getting the start and ends of those internal pullbacks, right? So we get that fractal shift, right? That change of character. There's the internal movement. Now, when price pulls back, if we get a bullish chock, right, that's our next internal leg. Okay, I haven't drawn it on, but you would get a bearish chock to signal the start of the internal pullback. I haven't drawn it on, but there would be a bullish chock here. That signals the end of the internal pullback and the next bullish internal leg. After an internal boss, what do we expect? We expect an internal pullback or an internal reversal because we're at the strong swing high. So we get the bearish change of character. That's the first aggressive sign for short. After the IBOS, we can expect an internal pullback, right? The chock will signal the start of the internal pullback. Then you would get a bearish chock. What does that signal? The start of the next bearish internal leg, so on and so forth. So do you see the relationship between them? Changes of character, so fractal structure trend changes, they signal the start and end of internal pullbacks, right? The internal movements, the internal leg. And then IBOSes, when you get the change in trend of the internal structure, that signals the start and end of the swing pullbacks, right? So the other variation is if you get like an internal high here and we break it in the previous leg, okay? And then we get the bullish trend, that's the swing pullback. When the swing pullback is complete, the internal structure shifts trend, okay? I appreciate for some of you this is simple, for some of you it's a lot to take in, I get it, but let's open the charts and I'll show you. So here we have a clear bearish trend, right? We get the swing high that breaks the swing low. After a swing break of structure, what do we expect? We expect a swing pullback, but we don't expect price to break the strong swing high, okay? So we get this large bullish move and we end up getting a change of character as well. So we can clearly see the internal structure is starting to shift bullish, right? We get an internal high or low that breaks the weak internal high. So this would be our bullish IBOS. But in this case, where are we? We're already pretty much at this strong swing high. So, we're not expecting that bullish internal trend to go too much higher because at any point that swing pullback can finish. And obviously we're expecting that next bearish swing leg, okay? So the first aggressive way to look for those shorts is where you get this little shift in fractal structure. We get the bearish chock. Now at that point, that can just signal the internal pullback and eventually we get the bearish IBOS to the downside. Once we get that bearish IBOS, that's the strongest confirmation that we have that the swing pullback is over and price is now ready to target that swing low, okay? So if I just remove some of these drawings to make it a bit clearer, all right, swing pullback, bullish internal structure, we pull back into the strong swing high, the internal structure shifts bearish, this becomes our strong internal high, price pulls back up into that strong internal high. This is high probability now to look for shorts because the internal structure is bearish, it's aligned bearish with the swing structure, this is a strong high, this is where we're targeting the weak swing low. Obviously in this case, price goes a bit further, okay? So can you really see the relationship between them? And so that's where structure comes in, right? When we got this internal movement up, after the IBOS, we expect at least an internal pullback. The bearish change of character signals that, right? Likewise, we got the bearish IBOS, and then within there, we got the bullish chock to start, but we don't expect it to go any higher than that internal high at that point. That's where it's all systems go. That's where we have full alignment between swing, internal, and fractal. Bearish swing structure, bearish internal structure. We've got the internal pullback into the internal high. Then we get the bearish fractal structure. Now all three structures are bearish, bang. That's the high probable trading where you have everything aligned, okay? One more example. In this case, right, it's all different shapes and sizes and forms. So that's why when you're learning the theory and the diagrams, you have to remember the rules, and then you get the experience of going, okay, how does it look like with real price action when it's going to look different in every scenario, but the framework is the same, right? So in this case, zoom out a little bit because we get a big range, right? That was our swing pullback. A new swing ends up being a swing high. So do you see sometimes you kind of get smaller ranges like here, and then sometimes you get bigger ranges because we get this big impulsive movement. So here, you could view that as a swing pullback. I just viewed that as an internal pullback in this instance because it wasn't quite as big as like the previous pullbacks. So what do we expect after a swing breaker structure? We expect a swing pullback. Okay, we get one leg lower, then eventually we get that bullish IBOS, right? So now the internal structure shifted bullish. This is our current swing. Expect the bullish internal structure to facilitate the swing pullback, right? Eventually, we get that swing pullback. The confidence we'll talk about a little bit. We come up range. Don't worry if you don't know what that means. The internal structure shifts bearish. So at this point, what do we now know? Now we expect it to stay bearish until it takes out the weak swing low, right? Remember here, right? Once we get that bearish eyeball, that's the end of the swing pullback, and that's when we expect price to then make its way down towards the swing low. That's this exact moment here, okay? We get the bearish eyeball to the downside. This is our strong internal high, so we can start to follow that bearish internal structure until it takes it. Okay, so that's the swing and internal relationship. Remember, you can go one step lower. Looking at the fractal to help you time the internal pullbacks. We get the bearish IBOS. It's getting a little bit choppy, right? It's not always super easy, but we get another signal. There's the bearish shock. There's the pullback. We get that next leg higher, right? Shift in structure there, and eventually get the internal reversal. Okay, after a bearish IBOS, what do we expect? We expect an internal pullback, but no higher than the strong high. And we get the bullish change of character here. So now we can play the internal pullback. Then what do we get? We get the bearish change of character. That's the signal of the end of the internal pullback, right? And then we go all the way down. Rinse and repeat. The same thing. Access this as far as possible. You will see the same things occurring, okay? Literally, there's just endless examples. Swing pullback, bullish internal structure, okay? Up into the strong swing high, bearish IBOS. Now we expect it to remain bearish until what? Until it takes out the swing low. Again and again and again. Don't just take my word for it. Go and prove it to yourself. Once you prove it to yourself, you have the data. Now you can see you have an edge. Before we've introduced other shiny concepts, supply and demand, liquidity concepts, you already have such a powerful way, even if you've got already a trading strategy, to add this to your arsenal now, okay? Okay, premium and discount. This is a very good way to basically help to see if you are entering at a good area of value, okay? So this is something called the Fibonacci tool, which you can grab over here. You can just copy my settings here if you want. Essentially, oh, there we go. It's just showing the halfway point, okay? The 50%, the 0, and the 1. What it basically represents is when you have a current range, the halfway point is the equilibrium. Everything below that is the discount prices. Everything above that is the premium prices. It's expensive. So if you're going to be selling, you want to be doing it in the premium, the top half of this range. And if you want to be buying, you want to be buying in the discount of the range. So not always, but generally pullbacks are going to come down into where? Into the discount level of that range, because that's where buyers are going to want to step in to push prices up. So if you're playing the pullback and you're selling, ideally you want to be doing it at the start of the move in the premium prices. You're buying, not ideal to buy up here, right? Because you might get false signals, but as we get down into the discount of the range, into that strong swing low, this is the ideal area you want to be doing it, okay? Exact opposite for selling, right? Bearish move, strong high. Where is the highest probably, right? Price does not have to pull back to premium pricing, especially when the trend is strong, it can just do this. But the best area to be selling is in premium, okay? That's where we want to be selling. And if you want to be buying to play the counter trend pullback, you want to be doing it down here. It's way higher and higher into those premium prices, into the strong swing high. Not going to be ideal to be buying, is it, right? So this is a quite simple way to kind of help you frame your ideas with that. So here you can see it, right? When you've got more kind of complex price action, where you have a large swing range, you can literally draw the range on this entire, if I grab that, the entire swing range here, and get the premium and discount. Okay, so from the swing low to the swing high, drag it across. Everything in the top 50% is what we call premium pricing. Okay, so buying up here is not going to be ideal, right? Because you might get the internal structure here, it might shift bullish, okay? But you're more likely to be getting false signals that the swing pullback isn't ready because it wants to pull back down into those discount prices nearer the strong swing low. Then if you get the bullish IBOS, that will be a much stronger signal that we're about to get that next leg, right? There's going to be a lot more buyers willing to step in those discount prices. And then likewise, you can take that to, again, this is advanced trading, okay? So don't worry overwhelming this. But when you're trading those internal ranges, okay, we know that price is going to want to likely pull back down towards the swing discount. But if you want to trade these internal ranges, wait for price to have the internal pullback into the premium of the internal range, right? So this is your internal range here. It's bearish. We're expecting it to remain bearish to facilitate that swing pullback. So we mark on, right, the premium and discount of the range. Price to pull back into the premium of this range, right, above the EQ. Now it's a nice level to sell down into the swing low. You see? And then likewise, as we pull down into what? Into the discount of this larger swing range, we get the bullish IBOS. We mark out this internal range. This is our strong internal low. Let price pull back into the discount of that internal range. Now we're in the discount of the internal range. We're buying pro internal trend, pro swing trend. Everything's alignment. This is high probable trading to now target that high. So do you see how these concepts, piece by piece, we're starting to overlay them together? So quick example from the 3 types we just looked at, right? Well, we had that swing range, draw it from the swing high to the swing low. And you can see how now strong bearish momentum, so pull all the way back up into this high. You can see, where did we come into? We came into the EQ of the range, the equilibrium. Good area for sellers to start stepping in and those more premium prices, okay? Then we got that bearish IBOS. So at this point, high probable trading to look for shorts. Why? Because the internal structure is aligned bearish with the swing structure. We can then try and time, where are we going to find that internal lower high? Where can we start to sell? So the premium and discount of the internal range. And where does price pull back into? It pulls into the premium of that range. Then what do we get? We get that bearish fractal chock, right? That change character. That's your short, bang. So another very, very, very simple tool, but it helps you to get in at the right areas of value. Now, the final piece of the puzzle with market structure is multi-time frame analysis, okay? So far, we have only looked at one time frame, but with 3 types of structure. Now, to be fair, if you truly get your head around the 3 types of structure and you just look at one time frame, you can honestly have a really, really profitable edge. But bringing it to that next level, really giving you this 3D look of the market, is when you bring multiple time frames. This is not beginner trading. This is really getting into that more intermediate and advanced, but do not be intimidated by it. The sooner that you start to tackle this and the sooner you get your head around it, the sooner you will see consistent success, okay? It's worth doing it. So multi-time frame analysis, analyzing multiple time frames together, okay? So if you were to look at a weekly candle, that weekly candle is going to be made up of 5 daily candles, which is going to be made up of a significant number of 4-hour candles, which is going to be made up of even more 1-hour candles, right? Hopefully that will make sense. Now, time is power. The monthly candles is going to be made up of a lot more price action than the weekly, right? So it's more significant, i.e. the weekly is going to be more significant than the daily the 4-hour, so on and so forth, okay? Now, similarly to what we were saying at the start of this video, that price action is simplified, right? And beneath that, there's all of those interplay dynamics of the order flow, buyers and sellers, how those orders are matched, aggressive and passive orders being filled. The same analogy can be used for multi-time frame analysis. When you're only looking at one time frame and you're seeing the candles of that time frame, they're made up of all of the lower time frame candles and price action going from that. And that's what understanding multi-time frame analysis is going to allow us to do, okay? The lower time frame price action can actually help us anticipate what's going to happen on the higher time frames and to help us time it. So let me give you the key, the absolute key that helped me to get my head around multi-time frame analysis, and hopefully that will help you. Okay, so what we've looked at so far, basic market structure. In a bullish trend, we get a series of higher highs and higher lows, right? And the breaks of structure. Hopefully you get that by now. Now, that runs the upside, right? We get a run, then we get a pullback. Then we get a bullish run, then we get the counter trend pullback, and then we get the next bullish run. So runs and pullbacks, okay, they're called market phases. So what you want to do is you want to identify first, we're in a bullish trend, we're making higher highs and then higher lows. But then in that exact moment, wherever price is, for instance, if price is up here at the top of this arrow, right now we're currently in the run phase, right? We're forming that pro trend run. So what will be the next phase? The next phase will be the counter trend pullback, okay? So those phases of runs and pullbacks, they collectively make up a trend. Pretty simple so far, hopefully you get that. The key is understanding that a phase on a higher time frame is a trend on a lower time frame. Okay, so each of those phases, that run will be a bullish trend on a lower time frame. That higher time frame pullback, that phase, will be a bearish trend on the lower time frame. So a higher time frame phase, whether it's a run or a pullback, will be a trend on a lower time frame. So here we can see that we have two time frames. The thick black line is what we could call a higher time frame. Think of the 4-hour chart if that helps you. And then the thin gray line is a lower time frame. Think of the 1-hour chart or the M15 if that helps you. So let's focus on the higher time frame first. Higher time frame run, higher time frame pullback. Higher time frame run, pullback, that turns into a run because there's a trend change, pullback, run, turns into another run, so you get a trend change, pullback, run. Okay. Now, let's say price action is over here, right? We are currently in a bullish higher time frame run. Now that run is made up of a series of higher highs and higher lows, a bullish trend on the lower time frame. Now, eventually, what is the higher time frame going to do? Eventually, it's going to run out of buyers, supply is going to start stepping in, and it's going to have that pullback. Okay. Now, what the lower time frame will likely do is the lower time frame will shift bearish to facilitate that higher time frame pullback. Okay. So think about it. The lower time frame fulfills the objective of the higher time frame, right? It's a soldier. It works for it. So if you're sitting on the lower time frame and you see that strong low break, and we get a lower low, we're now in a bearish lower time frame trend. This is your strong high on the lower time frame. So if you're only looking at one time frame, right, you're expecting this bearish trend to continue, right? It's broken that low. This is a strong lower time frame high. So as price comes into that strong lower time frame high, if you're only looking at the lower time frame and nothing else, what should you expect if you're following the framework? You should expect that strong high to hold, and you would expect that next movement. But then what happens is you get blasted and it changes trend. So this is where, if you're using multi-time frame analysis and you're looking at the higher time frame, you can now anticipate that that lower time frame trend is about to shift bullish. Why? Frame's only forming a pullback, right? So again, if I simplify it, get rid of the lines, higher time frame run, we know the pullback's not going to be that long, so therefore when we see the lower time frame shift into a bearish trend, we know it's not going to last very long. We can anticipate that once that higher time frame pullback is over, we're expecting the lower time frame to form a longer bullish trend to facilitate that next higher time frame run, right? Then it shifts bearish again for the pullback, shifts bullish again for the next run, shifts bearish again, so on and so forth. And then if you look at another higher time frame, say like the daily chart, what are you going to see? That bullish 4-hour trend is going to be what? One big daily bullish run. Then when the 4-hour chart shifts bearish, what is that in the daily chart? It's a daily pullback. Then when the daily forms the next bullish leg, what's the 4-hour chart going to do? It's going to shift bullish. Okay, that's how you get the 3D X-ray vision of the market. So far, when we're going through this multi-time frame analysis, I just only want you to think of swing structure and nothing else. Because if you try to understand multi-time frame market structure and you're thinking of 3 types of structure all at once, that's a lot. That's very hard for you to get your head around at this stage, okay? So for now, almost forget about the 3 types of structure, only think about swing structure, and then we can start to understand it, okay? So this thick black line, right, we're going to call that our higher time frame, and this is going to be the 4-hour chart. So what we'll get a bullish 4-hour break of structure and a bullish 4-hour run. After a 4-hour break of structure, we're going to eventually expect a 4-hour pullback, right, down into the discount of the 4-hour range, right? Eventually, we're going to get that next phase, which is the 4-hour pullback. Once that 4-hour swing pullback finishes, then we'd expect the next 4-hour run up towards the week 4-hour swing high. Okay, so we're only thinking about swing structure on the 4-hour chart. That should hopefully all make sense. Now, when we're at this point in the market, okay, when we're expecting that 4-hour pullback, what is the lower time frame going to do? The M15, okay? We're actually going to call this our middle time frame, right? Well, the M15 is going to shift bearish. Okay, so the M15 swing will shift bearish. I know I didn't say think about 3 types, but that's probably like a 4-hour chalk, but we'll essentially get the M15 shifting bearish. So now we can follow that bearish M15 swing trend. But we know that the M15 swing trend has only shifted bearish to facilitate the 4-hour pullback, right? So as the 4-hour starts to come into that 4-hour low and the pullback could be over, what are we going to look for on the M15? We're going to look for the M15 to shift bullish, right? Once that M15 trend shifts bullish, that's a very good signal